Logic says that the moment you stop earning a paycheck, your money starts shrinking. You have no income coming in, but your bills keep going out. Every month, your savings should get a little bit smaller. But for some people, the opposite happens. Their wealth quietly builds on its own momentum long after they have received their final paycheck. I first noticed this with my own parents. After retiring, they were bringing in far less than during their peak working years, relying entirely on their retirement accounts and a modest Social Security check. Yet year after year, they were worth more than the year before. It made no sense to me until I sat down and looked at the numbers. We are going to break down exactly how this happens, the common mistakes that prevent it, and the specific steps to take to make your money work this way. Because once you see the mathematical reality behind this, it completely flips how you approach building wealth right now, regardless of where you are in your career. If you have an investment account, pull it up this week. We are going to look at one specific metric from the past 12 months. Do not just look at your total balance. Look specifically at how much the account grew from returns alone, completely separate from the cash you actively deposited. This graph shows an account balance over time. It separates your active deposits, the linear block at the bottom, from the exponentially widening wedge of returns on top. For long-term investors, that top wedge of recent growth is noticeably larger than early returns. That is compounding starting to pick up speed. And that accelerating momentum relies entirely on leaving the capital untouched for extended periods. Getting this self-sustaining growth engine started early is the single most critical move you can make to eventually out-earn your physical paycheck. Now we can look at the first half of the crossover mechanism. When people retire, their everyday spending drops, often far more than they expect. When you work, a surprising amount of your income goes right back out the door just to support the job itself. Gas, transit costs, parking, work lunches, professional clothes, and convenience purchases, because you are simply too tired to cook during the week. We rarely add these up, but when you look closely, a massive percentage of your paycheck is immediately consumed by the daily logistics of earning it. The moment you stop working, those entrenched daily expenses vanish from your ledger. Walking away from your job permanently eliminates a massive structural drain on your finances. It instantly lowers the baseline cost of your lifestyle. Second, your investments enter an independent, late-stage growth phase. This chart shows compound growth's non-linear trajectory across decades. It starts painfully slow, almost completely flat, before sharply curving upward. Look at the top. Here, a single year of passive returns generates more capital than several years of active deposits combined. This explosive phase requires no new labor. It relies entirely on the accumulated mathematical momentum of the decades prior, with your money quietly building on itself. This chart illustrates when these variables collide. As work expenses drop sharply, your investment returns curve aggressively upward. That intersection is the crossover. From there, the gap between what you spend and what your wealth generates starts widening. When these two trends intersect, a climbing net worth becomes the predictable result of the math behind the crossover. Engineering a successful financial crossover requires the deliberate, careful alignment of two very distinct and powerful mechanical forces. This visual equation maps out the strict math of your net worth, everything you own minus what you owe. On the owned side, data points like property, cash, and equity represent your financial mass. Building that mass requires constant feeding. Reaching a point of alignment requires mastery over both variables. Unmanaged debt acts as a permanent anchor, dragging against any assets you manage to accumulate. This chart tracks your primary growth engine, the direct, linear savings from an active paycheck. A second, quieter engine runs in the background, the earnings from your investments. Through compounding, this background growth eventually arcs into an exponential curve, visibly outpacing your savings. The mechanical objective of your working years is to use the first engine to fuel the second, until your investments reach critical mass. Maintaining an active career generates a hidden, secondary layer of friction costs, known to many as work-correlated spending. Holding a full-time job mandates specific daily expenses, like your daily commuting, expensive professional wardrobes, quick convenience meals, and outsourced domestic tasks you no longer have time to perform yourself. This steady, reliable cash flow of a bi-weekly paycheck easily absorbs these costs. masking how much capital is actually leaking out of the system in the moment. This creates an artificially high baseline cost of living, setting a false ceiling for the amount of capital you believe you need to survive. The moment active employment ends, these hidden work-correlated expenses are permanently eliminated from your balance sheet. This sudden drop in overhead occurs simultaneously with the loss of your active paycheck, forcing the system to rely entirely on its own mass. This stacked bar chart maps the behavior of mature investments after that shift. Notice that the blocks representing new deposits sit at zero, yet the total portfolio value continues to climb. This internal momentum only works if the assets have been incubated for a sufficiently long period to reach a self-sustaining density. Retirement is a structural pivot. You are shifting the entire load of your survival away from active labor and onto the passive momentum of your capital. Market volatility ensures background investment returns are erratic over short timelines. Returns do not move in a straight line. Baseline spending also fluctuates. Unexpected repairs, medical bills, and emergencies create sharp spikes in your cost of living. If a spending spike occurs at the same time returns plummet, the system can collapse. The portfolio bleeds out capital faster than the background growth can replace it. Because these two forces are inherently unstable, the crossover requires strict, long-term discipline to prevent a terminal drain on your assets. The crossover relies on two prerequisites: years of suppressed expenses and relentless, consistent investing. This is the crossover where lowered spending aligns beneath your ongoing asset growth. Past this intersection, asset yield exceeds the capital required to sustain your life. If spending remains high or growth is weak, the lines run parallel forever. The crossover never occurs. The crossover is a rigid mechanical outcome. Earlier financial mistakes dictate whether this point of alignment will ever physically manifest in your lifetime. This graph shows the expected trajectory of post-career wealth. You work, you save, and you reach a distinct milestone, retirement. But the ultimate goal is achieving the financial crossover point. The crossover is the exact moment your net worth continues to climb entirely on its own, even after active work and steady paychecks cease. But if we look at the reality for the vast majority of people, this post-career wealth climb never actually materializes. Instead, the line stalls out and eventually begins to steadily degrade as time passes. When a portfolio stalls like this, the math is rarely the problem. The market is functioning and the initial calculations were likely correct. The failure comes from a series of quiet, destructive daily habits that work against the money over the course of several years. Identifying and eliminating these 5 invisible behavioral patterns is the absolute prerequisite to ensuring your wealth outlasts your career. The first mistake happens during the psychological shift of entering retirement. After spending decades being careful with money, there is an immediate temptation to treat the milestone as a deferred spending spree, buying the new car, taking the big trip, or completing the full kitchen remodel. Enjoying the money is the entire point of the process. But front-loading all of those major lifestyle purchases right at the start of the retirement window causes measurable mathematical damage to a portfolio. This chart shows a total portfolio during the early retirement window. This is the most critical phase because the portfolio is at its absolute largest and requires that capital mass to generate future compound returns. Compound returns are the profits your investments earn on top of their previous earnings. When a massive chunk of that mass is extracted right at the beginning, the projected future growth curve drops drastically. The second mistake is rooted in how people measure financial success. Throughout a career, individuals traditionally focus exclusively on achieving a high income by chasing raises, promotions, and side revenue. This visualization compares 2 different financial approaches. On the left, a massive income is perfectly matched by outbound spending, leaving zero margin. On the right, a modest income is paired with minimal spending. Lasting wealth is built entirely in the margin between what comes in and what goes out. A modest income with minimal spending creates an expanding wealth gap that outpaces from one with a massive income who spends nearly all of it. Failing to pace early spending or manage the margin between income and spending permanently disables a portfolio. Without that mass, the capital simply lacks the capacity to do the necessary heavy lifting later in life. Beyond early spending, there is the psychological stress of managing wealth during periods of sudden economic unpredictability. This graph illustrates our third mistake. We see a trending data line dip sharply as the market drops. Anxiety kicks in, and the reflexive investor instinct is to sell off assets or halt regular contributions. By freezing the plan at its lowest point, those temporary paper losses are locked in. Freezing a financial plan during a downturn transforms temporary losses into permanent damage. By exiting the market, the investor misses the eventual compound recovery entirely. The fourth mistake stems from a rule that sounds logical on the surface: the belief that an individual must be completely debt-free before investing a single dollar. This split visualization highlights a clear mathematical advantage. On the left, a low-rate debt metric is steadily paid down, while on the right, small amounts are simultaneously invested. Investing alongside debt payments triggers the compounding process as early as possible, while waiting to be entirely debt-free costs years of valuable time. Whether it is reacting emotionally to market dips or adhering to rigid debt rules, these actions actively sabotage the most critical ingredient of wealth building: continuous, unbroken time in the market. The final mistake is a matter of scale. Many individuals hold a distinct misconception regarding the actual duration of the retirement phase, assuming it is a brief, finite chapter. This horizontal timeline shows the severe risk of planning for a short window. It begins as a brief 10-year block, but retirement is a major phase of life that can easily span multiple decades. When the timeline is stretched to cover 30 or more years, the overlaid wealth metric stretches dangerously thin across the new distance. Underestimating this timeline dramatically increases the statistical probability of outliving your capital reserves well before the end of your life. Achieving a climbing net worth requires structuring your money to work relentlessly for decades after your active income generation stops. These 5 specific, quiet behavioral traps, treating retirement as a spending spree, prioritizing income over margins, freezing during market drops, delaying investment for total debt clearance, and underestimating the timeline, are the exact mechanisms that prevent the financial crossover from occurring. Overcoming these habits is entirely a matter of financial discipline, pacing, and protecting uninterrupted time in the market, rather than relying strictly on complex math or earning more money. Now that we have identified the barriers, we can address the solution. Here is the step-by-step tactical plan required to set up the crossover successfully. You want to reach a point where your net worth continues to climb long after you have clocked out for the last time. Getting there requires a system that breaks the link between your wealth and physical labor. Your net worth must grow independently of your paycheck. People who pull this off do not do it by getting lucky. They execute a specific 7-step sequence that anyone can start today. Step 1 is calculating your true cost of working. We often ignore the hidden expenses embedded in our daily routines. Think about the parking fees, the takeout dinners on late shifts, the extra laundry runs, or the backup childcare. Your job pushes you into these expenses every single month. When you subtract those hidden work costs from your gross salary, you find out how much is actually yours to keep. This smaller, true income block gives you a clear picture of your actual living expenses once you eventually stop working. Writing that number down is the required first step to knowing exactly how much wealth you need to step away from your career. Step 2 shifts the focus from evaluating those costs to putting your money on autopilot. Set up a monthly automatic transfer from your checking account into an investment account, ideally starting with a low-cost index fund. An index fund is a type of investment that simply tracks the performance of a broad financial market, rather than trying to pick individual winning stocks. This chart demonstrates 2 growth paths. The steep curve shows early automated compounding, while the flat line shows delayed savings. Getting your money compounding as early as possible matters far more than the initial dollar amount you invest. Step 3 requires making a decision about what happens when your income inevitably goes up. Before your next raise even shows up, create a rule. Commit a set percentage of that future increase, like half of it, straight into your automated investment account. Making this decision now captures the new money before lifestyle creep can absorb it into your monthly spending. By automating your baseline savings and capturing your future raises, your wealth builds itself. You gain fuel for your investments without feeling a single reduction in your current standard of living. Step 4 moves from generating new savings to protecting the money you have already built when you change jobs. Every time you switch employers, roll your old retirement account into your new company's plan or into an IRA. An IRA is an individual retirement account that offers tax advantages for long-term savings outside of an employer structure. Cashing out old accounts triggers immediate taxes and penalties, but the permanent damage is the loss of all future compounding on those dollars. Step 5 requires estimating what your actual spending will look like in retirement. Most people assume they will need to replace 100% of their current income to survive. This stacked chart shows total monthly expenses. Notice how the top layer of work-related costs permanently disappears when you stop working. That reveals a much lower retirement baseline, meaning your investments do not need to produce nearly as much cash flow as you might expect. When you rigorously defend your existing accounts and accurately target a lower future spending need, the mathematical distance to your final goal shrinks dramatically. Step 6 gives you the correct metric to track your progress over time. Markets move around constantly. You cannot measure your success by a single lucky year or get discouraged by short-term dips. This mind graph plots 2 key metrics. Track the trend of your long-term portfolio growth against the flat horizontal line representing your newly estimated yearly spending baseline. The crossover point is the exact moment your portfolio's growth steadily intersects and exceeds your yearly spending need. Step 7 is your final strategic lever. When you finally hit that target, consider voluntarily working exactly 1 additional year before retiring. Delaying by just 12 months provides a triple mathematical advantage. You get 1 more year of fresh contributions, 1 more year of uninterrupted compounding, and 1 fewer year of withdrawals. Aiming for the correct intersection metric and utilizing that final year multiplier ensures your net worth has maximum forward momentum the day you finally walk away. Building sustainable wealth comes down to 3 things. It is determined by how much money you keep, how long you allow it to grow, and how strictly you protect it from disruption. If this breakdown made the retirement math clearer for you, hit the like button. Send this video to anyone who still thinks retirement means watching their savings slowly drain away to zero. Let me know your crossover goal in the comments below, and subscribe so you don't miss the next video.